Hello, everybody. Adam Bergman here, tax attorney and founder of IRA Financial. On today's video, 3 important questions you need to know before setting up a self-directed IRA. This is a super important video. If you are looking to set up a self-directed IRA, thinking about setting up a self-directed IRA, heard about a self-directed IRA, just wondering, what the heck is it? What should I be thinking about if I want to set one up? You came to the right place. I will explain to you everything you need to know, take into account my legal background, my tax law background, the fact that I've founded a self-directed IRA company over the last 13 years. I'm going to give you everything you need to know from detail to detail. So first, let me just set the agenda. First, I'm just going to briefly explain what is a self-directed IRA. 2, why people want to use a self-directed IRA and why it's become so popular over the last 10 years. And thirdly, I'm going to go into the 3 questions you need to ask yourself before making a self-directed IRA investment. So let's start with the first question, or first agenda item, I should say. What is a self-directed IRA? Probably heard a lot about it, right? There's probably, $700–800 billion in self-directed IRA fund. It's still a very small amount of the overall $13 trillion of IRA funds out there and the larger $32 trillion of retirement funds. But I can tell you, I've been in this industry the last 13 years and the popularity of self-directed IRAs have literally exploded, especially the last 5 years. So what is it? Well, essentially, when IRAs were created back in 1974 by ERISA didn't distinguish between IRAs that invested in stocks and IRAs that invested in real estate. They created the rules for IRAs. And as part of the rules, there's essentially only 3 things you cannot do with an IRA. And they're found under Internal Revenue Code sections 408 and 4975. 408 says you can't buy life insurance and you can't invest in collectibles like art or diamonds or antiques. There's a special carve out for pure precious metals, bullion, and the like. And I'll get to all this in the prohibited transaction rules. And then third, you can't do any self-dealing or any transaction that directly or indirectly personally benefits you. So, and again, I'm going to explain all this. The prohibited transaction is actually the first question you need to ask yourself when setting up a self-directed IRA. So that's just, a little sneak preview. But what is a self-directed IRA? So as I mentioned, ERISA created IRAs. The whole idea was to incentivize more people to save for their retirement. The government doesn't want us to solely rely on Social Security. So we need to take it into our own account and save for our retirement. We have a private retirement system. Before 1974, if you didn't work for a big company like GE, you probably didn't have a retirement account, okay? Because 401ks really didn't exist and either did IRAs. So ERISA created IRAs, and essentially, there was no such thing as a self-directed IRA and a regular IRA you can set up with Fidelity. It's just the creation of an IRA. But what happened is, dating back to pre-1974, what's been the most popular asset investors invest in? It's equities, right? Stocks. Mutual funds weren't even starting by then. It was really just stocks. So that's what the investment community gravitated towards. They said, okay, this is great. We're going, the IRS and Congress is allowing IRAs. Let's offer them products, i.e. stocks, because there's all this cash available and we can make money selling stocks. So that's how the whole industry started. They said back in 1974, real estate, there's no cryptocurrencies. It really was just focused on equities. And the Fidelities, the Vanguards, the large institutions automatically just opened IRAs and said, hey, what we do is we sell stocks, we sell investments. So that's what we're going to offer IRAs. There was a beginning movement dating back into the late 70s and a concept of, one could invest in alternative assets like real estate or hard money loans or gold with an IRA. There was just really no good way of doing it. So what a lot of people did, or not a lot, but some smart people did, and I actually know there's an individual named Nat Weaver, he in Orlando, and actually know his daughter very well. And he was one of the first people to set up what's called a custodian self-directed IRA. He basically worked with a bank and said, okay, the IRAs will be open to the bank, but we'll do all the administration for the alternative asset. We'll make sure that it's valued properly. We'll take care of all the custodian work. And he started offering alternative IRAs to anyone that wanted to invest in alternative products. And that was the beginning of the self-directed IRA movement. Initially, it was quite small. And it expanded as real estate, as various alternative asset products become more popular, the industry expanded. And the reason the Fidelities and Schwabs don't allow you to use your IRA to do many alts, or at least alts they don't make money on, is it's dollars and cents. They do not make money when you buy real estate, right? If you had $100,000 with Vanguard and you wanted to take $80,000 out of it to buy a house, guess what? They just lost $80,000 of cash. So now they're stuck with $20,000, which is less than the 100. So they have no financial incentive to allow you to do alternative assets. So they don't. But this whole niche market of self-directed IRAs began. So in other words, to keep it simple, self-directed IRA is just a regular IRA. It's the same IRA. You're going to open a Schwab, Fidelity, Vanguard, Merrill Lynch, Chase. The only difference is it allows you to do alternative assets. It's the only difference. It's the same IRA, subject to the same rules. Contribution limits in 2023 is $6,500, $7,500 if you're over 50. Same distribution rules, Roth, SEP, simple, same everything as your regular old IRA that you would set up at Vanguard or Fidelity. The only difference is you're allowed to do alternative assets. So now you know what a self-directed IRA is. Why would people want to do it? What's the attraction? Well, as you can imagine, number one, people want to diversify. People don't want to have all their eggs in one basket, right? You've heard that cliche before. God forbid you have all your investments tied into one stock and that stock runs into some trouble. You don't want to lose all your money. You need to diversify. You need to spread out your risk, okay? And the idea is that, hey, if you allocate your risk accordingly into different asset classes, you're going to be, as from an investor standpoint, in a stronger position over time. So the idea is that, hey, people have most of their savings still tied up in equities, mutual funds, ETFs. Let's give them the ability to diversify. And that's why ERISA allowed IRAs to invest in alternative assets. It's not a new thing. Back in 1974, Congress understood it's important to diversify. They allowed and understood that Americans want to invest in different assets, not just stocks and bonds and mutual funds and ETFs. So that's why they allowed for real estate. You know, you may talk to an investment advisor and say, that stuff's dangerous. You don't want to buy real estate in your IRA. That's crazy. Well, guess what? Congress allowed for it back in 1974. So they weren't worried. And that's the concept. Number one, diversification. Number two, people want to invest in what they know and trust. Listen, I grew up in New York. I have friends that and family that worked on Wall Street. I trust Wall Street. I do. I am in the self-directed retirement world. I have a lot of assets in real estate and cryptos, but I also have assets in equities. I do believe in diversification. I'm one of those that believe you should have assets in different asset classes. So I do have a chunk of my money also in equities. And I don't think anything's wrong with it. It's the same token. I don't think anything wrong in putting your money in assets you believe in, like real estate. I have a lot of clients that are just very good at real estate. They don't really understand Wall Street. They don't understand why stocks go up and down, but they understand real estate. They feel comfortable doing real estate. And that's what they want to do with their retirement account. So Congress, based off ERISA, allows them to do it. The third reason is hard assets, right? We are living in a high interest rate environment. We have high levels of inflation. Real estate is seen as a good hedge against inflation. You have a hard asset. If you have residential real estate, you can always increase rents yearly. You have flexibility. So there is a strong belief that real estate and other alternative assets are a good hedge against inflation, offer a strong source of diversification, and also for certain investors are just more trustworthy and they just feel better about their investment when they invest in an asset that they understand. So now you also understand why self-directed retirement accounts have become so popular over the last, 10 years, but especially the last 5. And obviously with COVID, everything just got crazy where people just wanted to invest more in digital assets, fractional real estate, just NFTs, different types of stuff. And that's kind of opened the door. And I feel that that door is just not closing. It's younger folks, Generation X, Zers, they just feel better, and not better, but they feel comfortable investing in digital types of assets. And that's just not going away. So now that you know what a self-directed IRA is, why you may want to do it, and why people have done it, let's talk about, these are the three questions you need to ask yourself before setting up a self-directed IRA. So give me the next 15, 20 minutes, and I'm going to tell you everything you need to know from a lawyer to you about setting up a self-directed IRA. And I'm not just any lawyer. You can ask my wife. I don't know a lot about other stuff, but I know this stuff better than anyone in the country. I've written 8 books on self-directed retirement topics. I have a master's in taxation. Put myself up against anyone in the country on self-directed retirement. Not on 1031s. If you have, S corps, or you want to set up a trust, I'm not your guy. But if you have questions on self-directed retirement accounts, solo 401ks, there's no one better in the country, and that's just the truth. Call me conceited, but I'm just going to speak the truth. My wife doesn't let me talk about anything else, but I know this stuff. Trust me. She even listens to me. So first question, I talked about it's prohibited transactions. So the first question you need to ask is, say, okay, I'm looking to do something with my IRA. Hopefully you have some concept of what you want to do, whether it's real estate, hard money loans, cryptos, gold, private placements, hedge funds, private equity, whatever it is. First question you need to ask is it a prohibited transaction? Okay. What's a prohibited transaction? Well, there's 3 things that are prohibited that you cannot do in your IRA. I mentioned the first 2 prior: life insurance, collectibles. Okay. Let's focus on 4975 prohibited transactions. So essentially, when you invest in an IRA investment, this is what you need to remember. Okay. You cannot do anything with your IRA that in any way, directly or indirectly, personally benefits you, since you are the fiduciary of the IRA, or any disqualified person. And a disqualified person is defined as you, your lineal descendants, parents, children, spouse, daughter-in-law, son-in-law, or any entities or trusts controlled 50% or more by you or any disqualified person. Okay, that in a nutshell is what a disqualified person is. If you own 50% or more of a company, then potentially board members, highly compensated employees, executives, and other 10% or more shareholders can also be deemed disqualified as well. So it's something to remember. So the first thing you need to know is, okay, I'm investing my IRA in transaction X, transaction Y. Who's on the other side of the transaction? Is it a disqualified person? If the answer is no, you can probably do it. Okay, if you're investing with John Smith, Joe Schmo, Jane Jones, and you have no relation to them, you are not affiliated with them, they're not family, you're not involved in any business with them, you can do it. You can move to question 2, which we'll get to in a minute. But if there is someone on the other side, even if they own 1 or 2% of the company, you got to start thinking. Okay, so again, prohibited transactions, life insurance, no. Collectibles, no. And any transaction under 4975 that in any way, directly or indirectly, personally benefits you as the IRA owner or any disqualified person, parents, children, spouse, daughter-in-law, son-in-law, or any entities controlled by such person. Can't do it. Why? The IRS is basically saying, listen, if you want to do something prohibited, then take a distribution, right? We need to protect these distribution rules. Why? Because if we don't, people are just going to give the money to their kids or their spouse, and no one's going to ever take RMDs. They're just going to deplete the IRA, give it to their kid, and everyone's happy. The problem is the IRS, Treasury down the road counts on distributions from IRAs, especially pre-tax IRAs, that becomes taxable when you pull the money out after 59.5. They need to protect those rules, because if not, people are going to deplete their IRA, never pay tax on the distributions. So that's the whole purpose of these disqualified person and prohibited transaction rules, is they need to protect the distribution tax regime. So again, if there's no DP on the other side, you're good to go. Move on to question 2. If there is a disqualified person, what you need to know is, okay, am I investing in an entity? Yes. Okay. Are there disqualified persons that own more than 50%? If they do, no bueno, no good, can't do it, right? Because the entity becomes disqualified. What happens if there's a disqualified person like a child that owns maybe 10 or 20 or 30%? Can you do it? Well, seemingly on its face, you should be able to. Why? Because the entity is not disqualified. However, now you get into what I call is the prohibited transaction gray area under 4975 C1 D, E, and F, where it's more of self-dealing, conflict of interest, facts and circumstances. Okay, and I'm going to give you an example. True life tax court case, Rollins v. Commissioner, 2004 tax court case. Mr. Rollins was an accountant and, excuse me, just need a little espresso. And I just get super jazzed when I talk about this stuff. Wanted to invest, well, actually, the companies were in some financial despair. And he was an investor in a bunch of companies, all under 50%, not an employee, just on the board. And the companies needed money. So what he did is he took his 401k and lent the company money at prevailing interest rates. And I've used this example before, really good example explaining how a prohibited transaction could get triggered even if there's a disqualified person that owns less than 50%. You would think, well, if the entities own less than 50% by DPs, you're good, right? I mentioned an entity is only disqualified if a disqualified person's own more than 50%. In this case, say my son owns 30% and I want to use my IRA to invest. Can I do it? Well, it's a facts and circumstances test. So I need to be able to prove to the IRS that my investment is being done exclusively to benefit my IRA, not in any way to help my son or me. Going back to Rollins. Rollins lends these funds from his 401k to the company. Somehow he gets audited and the IRS says, hey, Rollins, you did a prohibited transaction. You lent the money to these companies and it was for your benefit. And Rollins turns around, says, no, entities aren't disqualified. I'm good. Can't stop me. And goes to tax court and Rollins loses. And basically the judge says, Rollins, you can't prove that you are not receiving any indirect personal benefit from that 401k investment, that loan. You need to be able to show that 100% of the benefit is being derived by the 401k. And here, the fact that really killed Rollins is that the companies needed money. If the fact was different, meaning the companies were doing great and there was 50 investors lining up to invest, then I think Rollins wins. Because then I think he can say, listen, IRS, tax court, I didn't have to lend the company money. I could have got it from 30 different places. I only did this loan because it's a great deal for my 401k. Company didn't need the money. I think he wins. But because those weren't the facts and he did the deal, indirectly to help himself out, he lost. So that's why the prohibited transaction rules on its face are generally simple, right? No life insurance, no collectibles, no transaction with a DP. If it's an entity, it can get a little bit confusing because even if you're under 50% ownership of the entity by disqualified persons, that Rollins case still could potentially apply. And that's when you really want to work with tax advisors, IRA Financial, companies like that can help you navigate these rules, go through case law, revenue rulings, procedures to make sure you understand what's going on. Okay. An easier example is that, hey, I want to lend money to my kids straight away. No, I can't do it. Why? My IRA is on one side of the transaction, my kid's on the other, my kid's a DP, can't do the deal. What happens if I own a house and I want to sell it to my IRA? Can't do it, right? I have an IRA on one side of the deal, me as a DP on the other side. The tricky part is investing in entities or funds where a disqualified person owns under 50%. Now, obviously, if you're investing in a publicly traded company, your IRA and you can invest in the same company, right? There's millions and millions and millions of shareholders. Don't even worry about it. When they're closely held, privately held, under 100 shareholders, you gotta think this through. Now, if you own 1% of the company and your IRA is going to invest and maybe own another 0.2%, probably not a big deal. But if your IRA is going to own 30 or 40% and you're going to own 4%, you're going to get up to 40, 45%. That's when I think you still need to run an analysis. So the prohibited transactions generally are not super complicated, but they could be. And that's the point, that's the first question to ask. Is the deal I'm doing prohibited? Is the investment I'm doing potentially prohibited? If there's no DP on the other side, let's go to question 2. If there is a DP on the other side, even if they own less than 50% of that entity, this is when I think you want to speak to one of our brilliant, tax professionals, call us, chat us, email us, and we can talk it through. And maybe you do it, maybe you don't, but you should know the potential risks of the PT. So question 2, now that you understand the prohibited transaction, hopefully you've just stepped through question 1. You're like, okay, I'm good to go. There's no prohibited transaction here. I'm cool. Step 2. Step 2 is unrelated business taxable income, UBTI. I coined this ugly 4-letter word. Why? Because it is an ugly tax that can go as high as 37%. That could turn a very tax efficient investment into a tax nightmare. Okay, just a quick background. UBTI was put in the code in the 50s. It's really was intended to apply to charities like hospitals or Red Cross. They essentially didn't want businesses to set up charities like McDonald's, run a charity, sell cheeseburgers through the charity and never pay tax. Why? Because charities are tax exempt and don't pay tax. So they basically said, listen, if you're a charity and your exempt purpose is to save lives like a hospital and you're selling flowers, you're selling ice cream, we're going to tax you as a business because that's not part of your exempt purpose. That's why if you go in a hospital, there's gift shops and they sell flowers and there's a parking garage. They always outsource that. Why? Because they'll just take the rent from the space. The rental income is not subject to the UBIT tax. Whereas if they ran the store themselves, they're going to be subject to UBIT tax, which can go as high as 37%. It actually is higher than the individual and corporate tax. It follows the trust tax rates, which are higher. And the issue is, it's not like you hit the 37% at 700,000 of income. You hit it around 17 or 18K of income. So it's a very low income threshold when you hit that 37% max tax. So it's a killer. Okay. So how do you trigger UBIT? These are the 3 things you need to remember. These are the only 3 ways to trigger UBIT in an IRA. 1, use a non-recourse loan to buy stocks, like margin. Number 2, non-recourse loan to buy real estate. Why am I saying non-recourse? Because if you go back to 4975 and the prohibited transaction rules, you're not allowed to personally guarantee an obligation in your IRA, meaning you can't personally guarantee a loan for your IRA. So what's a non-recourse loan? It's a loan you do not personally guarantee. So that's why it has to be a non-recourse loan. So that adds complexity. Why? Generally, when you get a non-recourse loan, you're going to have to pay a higher interest rate because the lender is taking a higher risk, right? There's no personal guarantee. So if you stop paying, all that the lender can do is go after the asset, the underlying asset. They can't go after your personal asset because an IRA does not allow you to personally guarantee an obligation of your IRA, just the way the rules are. Also, the lender is generally going to require 30 to 40% down, just a bigger risk profile. So that adds a level of complexity. Okay. Note that if you use a 401k, there is an exemption for using a non-recourse loan to acquire real estate. You could use a non-recourse loan to acquire real estate without triggering this UBIT tax. That's one enormous advantage of the solo K over the IRA, besides high contributions, a loan feature, lets you borrow 50K tax-free, penalty-free. The exemption for UBIT is a huge win for real estate investors. Why? Every good real estate investor wants to use leverage, right? You've heard the term before, other people's money. You want to use other people's money. Smart real estate investors put the least amount of personal cash at risk. They would love to put 0 at risk and just borrow 100%. It's not always possible, right? Generally, they got to put 10, 15, 20% down. But the less cash they have to put down, the more buying power they have. So leverage is key. Almost every real estate deal, hedge fund deal, you'll see there's going to be leverage. So if you are investing in a real estate investment fund, you may have to ask about UBIT. Why? Because UBIT can turn the deal into a nightmare. Well, because let's say instead of buying this investment with leverage, you just bought Tesla or gold or Bitcoin or just did a house fix and flip with no leverage, those transactions would not be subject to tax. Whereas this real estate fund that has leverage, the income attributable to the leverage would be subject to this UBIT tax. So it's a problem. Okay, so those are the two ways at first, right? Non-recourse loan to buy real estate, non-recourse loan to buy stock. The third is if you invest in an active trader business, like a restaurant, that's operated through an LLC or partnership. I said the words LLC or partnership, not corporation. You may be saying, hey, Adam, I own Tesla. I own Apple. I never heard of this UBIT. Am I in big trouble? Am I going to jail? No. Why? Because almost all publicly traded companies are corps. Think of the corp as a big box. It boxes in the income. There's a corporate level tax. So there's no reason for the UBIT tax to apply because there's already a corporate level tax. Whereas an LLC, think of it as like, a funnel, right? It just like funnels up. There's no box. So there's no entity level tax. An LLC, a partnership, one level of tax at the shareholder member level. Corporation pays two taxes, one at the entity level, one at the shareholder level. Because an LLC or partnership's a flow through, pass through taxation, the UBIT tax applies to the pass through, not to the corp. Why? Because the UBIT tax wants to impose a tax on that income, whereas the corporate tax already is imposed on that income. So if your IRA invests in a passive business, your friend's business, or even a venture capital fund, and those underlying portfolio companies or LLCs, you may have UBIT. Now, UBIT is only applicable on entities or investments that generate at least $1,000 in net income. So if you're doing startups, venture capital deals, probably not a no net income, no profit, no UBIT. A lot of real estate deals in the first number of years, there's no net profit. Why? Depreciation, other expenses, no net profit of over $1,000, no UBIT. How is UBIT calculated? So let me give you just a very simple, two simple examples. One real estate, one pass through. Let's say you put in 100K in this real estate deal. Keep it simple. It's just you and a buddy. You each put in 50K. So you have 100K total and you borrow 100K. So it's 200K total. So that's 50-50 debt to equity ratio. You own 50% of the fund. Okay. Now let's say there's $20,000 in net income. So you're over that $1,000 threshold. Since 50% of that $20,000 is allocated to the debt, $10,000 is subject to UBIT. You own 50% of the fund. So $5,000 of the $10,000 would be subject to the UBIT. So in sum, $5,000 of the $20,000 would be subject to the UBIT. $10,000 of the 20 is allocated to the debt. You own 50% of the fund, which means you're allocated 50% of the debt, 50% of the UBIT tax. You pay UBIT tax on the $5,000. Subject to a 990T, that's where it's filed, April 15th. IRA Financial can help you file it, so don't worry if you're a client, we can help you with that. But the biggest issue with UBIT is when you invest in hedge funds, private equity funds, sometimes you're not even aware there's UBIT. Why? Because you get a K1. You're not active. You're passive in the fund. And if you're not aware of the UBIT, how the hell are you going to report it? And you can't. And that's why some funds won't take IRA or 401k investors. Or if they take them, they make sure they're under 25%. Why? There's something called plan asset rules, which I will tackle in another video because it's super complicated. More so for 401k plans, which brings into bear fiduciary risks for the fund promoter, also prohibitive transaction risks. But focusing on UBIT, a lot of funds just don't want to deal with the UBIT calculation, so some won't even take retirement accounts. Others will, and maybe they use a blocker. So what's a blocker corp? A blocker corp could either be a domestic corporation or a foreign corp like Caymans or BVI, British Virgin Islands, where the IRA will invest in. And because the blocker corp is investing in the US fund, there's no UBIT because you have a corporation. And since BVI and Caymans are tax exempt, there shouldn't be any corporate tax. Now, if you use real estate in BVI, there's some exemptions on withholding, which gets you around 30% withholding tax. Cayman, same with capital gains on hedge funds, private equity funds. So depending on who you're investing in, foreign blockers could be an option. You want to ask about it, but foreign blockers are expensive, so not every investment fund will offer it. You can do a US blocker. You'll reduce the max 37% tax to 21, but you're not going to reduce it to 0. You're still going to pay some tax, right? 21 is better than 37, which is the max UBIT tax. Still not as good as 0. So not great. So bottom line is, now that you know if your transaction is prohibited, hopefully it's not, the next question is, okay, what am I doing here? Am I investing in a non-recourse loan to buy stock? No. Am I using a non-recourse loan to buy real estate? Maybe. Am. Is the fund a pass-through or is the entity a C-Corp? If it's a C Corp, no UBIT. If it's a pass-through fund, maybe UBIT. Am I investing in a pass-through business, private business? Yes. Is it a C Corp or an LLC? LLC, potentially UBIT, over $1,000 in net income. C Corp, no need to worry. So when you're thinking of UBIT, if you hear of C Corp as the investment vehicle, move on to question 3. If you hear LLC pass-through, you need to consider UBIT. Okay, is there net profit? How is this being structured? Another reason why you want to talk to tax professionals, whether it's IRA Financial, your tax advisor, someone, because you need to understand, hey, even if I get around the privilege transaction rules, you don't want to trigger UBIT because, again, you're going to impose potentially a 37% tax on your investment. That's not good. You don't want to be in that situation. You want to make sure there's opportunities to restructure. So it's important to understand and navigate these rules prior to doing the investment. Because you know what? Sometimes if I talk to a potential client, I may say, hey, honestly, if you have the money personally, don't use your IRA. The UBIT's a killer, don't do it. In other times, we'll structure it maybe through a blocker. Maybe the equity investment will be turned into a loan since interest will be exempt from UBIT. Maybe the facts are that there'll be so many losses. The losses will offset any future UBIT and the loan will be paid off in a quick amount of time. So ultimately, when the asset's ready for sale, there's no leverage and there's no UBIT. So it's hard just in a video to kind of tackle every potential scenario. That's why it's really important to work with a company like IRA Financial or other great companies in the self-directed retirement space that can help you navigate these questions. Because trust me, I've been doing this 13 years. I got 25,000 clients. Nothing hurts me more when I talk to someone who said, Adam, I did this deal 8 months ago, 2 years ago, and I feel like I never reported UBIT. I didn't think about it. No one told me about it. And now I'm in this issue. I'm in this predicament. God, I wish I spoke to you 2 years ago. You don't want to be in that place. Okay. So privilege transaction, hopefully you're a no. Check that box off. UBIT, hopefully you're a no, right? You're investing in a C Corp. There's no leverage. You're investing in a real estate fund with lots of losses. Hopefully you can check that box off. And now you move to the third question is, okay, now that I know I'm not doing a privilege transaction, hopefully not going to trigger UBIT, good to go. All the income or gains will be tax deferred or tax free if it's in a Roth. Now the fun is, should I do a self-directed IRA or self-directed IRA LLC? How do I want to structure my self-directed IRA? Okay, I'm 5 minutes. Give me 5 minutes. I'm done. I promise. This is going to be quick. Okay, so you have two choices. You can do a straightaway self-directed IRA. We call it a full service or custodian controlled, meaning the IRA from IRA Financial will do the investment directly into the underlying investment. So example, Adam has 100K Fidelity, wants to invest in Fund A, opens an account at IRA Financial, goes on the app, takes a day. IRA Financial does a KYC, gets the account approved. We initiate the transfer from the Fidelity. 100K gets moved over. 4 days later, you're notified by IRA Financial, and now you have to go on the app and say, okay, send the money to Fund A. It's part of our investment authorization process. You upload some subscription docs, private placement, whatever the case may be. We sign it, and then we wire the money. If you're doing one-off investments that don't require lots of transactions, investments that don't require limited liability protection, then it's fine to do a full service, right? If you're investing in a private equity fund with a 5-year holdup, investing in your neighbor, your buddy's business, where there's not going to be a capital event for 3, 4, 5 years. If you're investing in cryptos, you're investing in gold. If you're investing in investments where there's not a lot of transactions, then you don't need the LLC. You can use the LLC, but you don't need it. Why? Because the LLC is used for a number of important factors. Number one, limited liability protection, right? What's limited liability protection? Limited liability protection protects your assets outside of the LLC. So if you have 200K in your IRA and you're investing 100K, okay, in this LLC, so you have 100K left in your IRA outside of the LLC, and God forbid a fire comes and the property blows up, all a creditor can do is go after the 100K in the LLC. They cannot go after the 100K outside of the LLC. That's called limited liability protection. Whereas if you had no LLC, then potentially your 200K of IRA funds would be subject to attack. Okay, potential. So limited liability is important because it protects your assets. There's a small establishment cost, one-time setup fee for an LLC. We handle everything, but it's not expensive. And if you're doing transactions, especially real estate, where you want limited liability protection, it's definitely, I think, worthwhile. Another reason why people want LLCs is control. Right? Remember my example? Talked about I'm investing in a fund. I have to upload subscription documents. I have to get IRA Financial to sign it. Why? Because title will be in the name of IRA Financial Trust Company for the benefit of Adam Bergman IRA. If I invest through an LLC, the LLC will take title, meaning the asset will be titled, the investment will be titled XYZ LLC or ABC LLC or White Wall LLC. Okay, so control is cool. People want control. You as the manager of the LLC would have the control. So the way an LLC is worked is the operating agreement will show it's manager managed, not member managed. The LLC will be owned 100% by the IRA or multiple IRAs. Okay, you'll manage it as per the operating agreement, giving you, the IRA owner, checkbook control. We'll be able to open a bank account for you at Capital One, or you can use any bank of your choice to manage that bank account process. And then you could wire the money to the fund. You, as manager of the LLC, could sign the transaction documentations. You just have a little bit more control over the process, maybe get things done a little bit quicker. Now, IRA Financial has no transaction fees. So you won't be saving money, but you may be saving time. And the third reason people like LLC is privacy or anonymity, right? If you use an LLC, you can call the LLC almost anything you want, and it's much harder for someone to know who owns the LLC. Whereas if you're investing in a fund or a private business and you're investing through an IRA directly in a custodian-controlled approach, the title is going to say IRA Financial Trust Company for the benefit of Adam Bergman IRA. So everyone's going to know you're using your IRA. Whereas if you use an LLC, no one's going to know if it's your personal money or IRA money. So again, if you're not, just want more privacy, if you don't want people knowing your business that you're using an IRA to invest, I definitely think it makes a lot of sense to do the LLC. So that's the last question is, you're not doing a privilege transaction, you're not triggering UBIT. Do you do a full service IRA or checkbook control? There's no right or wrong answer. I've had plenty of people do LLCs for Bitcoin and full service for Bitcoin. I've had plenty of people do full service for real estate and LLCs for real estate. There's no right or wrong. It's whatever you feel is right for you, for your particular investment. That's why the transaction is called self-directed IRA. You're self-directing. You're in control. It's up to you. It's what you want to do. We'll facilitate any way you want to do it, but whatever you want to do, we'll do. Okay, so those are the three questions you need to know before you make a self-directed IRA investment. You don't want to trigger privilege transactions. You do not want to trigger UBIT. If you are triggering UBIT, you want to make sure you're circumventing or at least thinking about ways to circumvent the UBIT rules. And then ultimately, once you know you can do the deal without triggering the perimeter of transactions and the UBIT rules, how are you going to do it? You're going to do a full service IRA, or you're going to use the LLC. Okay, let's go through one question here from Hannah. Would the LLC be owned by the IRA itself or the custodian? So essentially the IRA is the custodian, right? The custodian is the trustee of the IRA. Okay, whether it's Vanguard, Schwab, or IRA Financial, the custodian is the trustee of the IRA. So title of the investment would be IRA Financial Trust Company for the benefit of the IRA owner. Whereas if you use the LLC, the IRA owns the LLC, and the LLC vehicle would make the investment in the LLC. So an LLC would get an EIN. It's a separate entity. Even though if it's owned by one IRA, it's treated as a pass-through entity for tax purposes. From an entity standpoint, it's still, under most state law, receives limited liability protection. It's still respected as a separate entity of its owner, or from its owner. So yes, the LLC, we would acquire its own EIN. We'll do the operating agreement. We'll do the articles. We handle everything. Is it for everyone? No. It's what you want. Okay, but you should know that you do have the option. You can do the full service. You can do the LLC, which has one-time establishment cost and small state annual administration fees. it is something we can discuss with you and make sure you're choosing the right structure for you, because it's important. And the last thing I'll say is if you're self-employed or you have a business with no full-time employees, which means less than 1,000 hours, or 3 consecutive years of 500 hours or more, the Solo K is an awesome solution. Why? Because you get the same checkbook control. You don't need the LLC. You can put away $66,000 or $73,500 if you're over 50. You can borrow $50,000 tax-free, penalty-free, and you get that exemption from the UBIT tax if you acquire real estate with leverage. So I'm going to do another video on the Solo K and questions you should ask before doing an investment, because I think this is a lot of fun. But note, privilege transactions, 1, no UBIT, 2, thirdly, you go full service, self-directed IRA LLC, or if you're self-employed, you probably want to go Solo K. If I could, I put every client of mine in a Solo K. The only time I wouldn't is if someone doesn't have their own business or they're using Roth IRA funds, because Roth IRA funds cannot be rolled into a 401k. Otherwise, the Solo K wins almost every time. Last question. You should obtain 2 unique EINs, right? One for the IRA and one for the LLC. You don't need to. The only time you need a unique IRA EIN is if you're filing a 990T. Otherwise, there's no need for it if you're doing the LLC, because the LLC will be the investment vehicle for the transactions, not the IRA directly. And the IRA is held with the custodian, so you can use the custodian's EIN. But if the IRA is making the investment directly, then yes, the IRA could get its own EIN. We can help acquire it. You can do it with the IRS for free. We'll take care of it for you. Not a problem. But again, it depends on what works for you. So that's it. That's a wrap. I hope you guys enjoyed it. I hope now, if you are thinking about doing a self-directed IRA, you understand what it is, why people like doing it, why they're popular, so popular, and 3 questions you need to ask before doing it. Understanding 1, privilege transaction rules, 2, not triggering UBIT rules, and then thirdly, obviously, should you do a full service or a self-directed IRA LLC? Last question. I've asked because I've seen custodians advertise IRA LLCs and said they use the EIN of the custodian to title your assets. Yeah, that makes no sense. They probably don't know what they're doing. They can use the custodian IRA if they're not using an LLC, but if you're using the LLC, the whole purpose is the LLC is the vehicle. You're getting the limited liability protection. You want to use the LLC EIN. There are potential times, maybe completing a W-9, when you may need to use the custodian EIN, but not for investment purposes. Will K1 suffice as proof of fair market value at year end? Maybe, maybe not. K1s don't provide valuations. They could provide a capital account, but if you're not sure of the valuation and you're not taking a required distribution, you can generally use the investment value you use, the cash you invested in, unless your investment was marked to market or you have a better idea of fair market value. But the K1 doesn't always tell you, fair market value of the business. So just something to be, focused on. That's it. I know I spent almost 45 minutes on today's video. I had a lot of fun. This was awesome. Sorry, I went on a tangent, didn't mean to, but hope you guys enjoyed it. Hope you learned a lot. That's my goal, is to use my tax and legal background to educate all of you, and so you can become better, more successful self-directed retirement investors. Have an amazing day. Don't forget to subscribe to this channel. Amazing content. We drop 3 to 4 videos a week, 3 podcasts, and there's some really great stuff on it. So subscribe, it's free, and I promise you'll be a lot smarter for doing so. That's it. Have an amazing day, and talk to everyone again next week. Ciao. Take care.